In just 3 months, one single platform quietly processed over $100 billion in global sales.
Yeah, which is just a staggering number.
Right, and you probably didn't see their logo a single time. So today, we are lifting the hood on Shopify.
We are indeed.
And, whether you're prepping for a high-stakes board meeting or trying to map out the whole e-commerce landscape, or you're just someone who, loves understanding how massive systems work, we're going to dive deep into the raw machinery of this company.
Because it's a massive machine.
It really is. I mean, if you look at their first quarter of 2026, they facilitated $100.7 billion in gross merchandise volume.
Just massive scale.
And they generated $3.17 billion in revenue in just 90 days. That's a 34% year-over-year growth.
Yeah.
But to really understand how a machine that big operates, you can't just read the glossy press releases. You have to learn how to read their actual financial disclosures.
Which is honestly an entirely different dialect of business.
Sure.
We spend all day interacting with these slick, highly optimized storefronts in the digital world, right?
Oh, yeah, constantly.
But when you transition over to regulatory filings, it feels incredibly dense. It's dry.
Very dry.
Yeah. But it's also the only place where the absolute unfiltered truth of a company's health and their strategy actually lies. I mean, if you want to know what a company is going to do tomorrow, you have to look at what they are legally obligated to disclose today.
Okay, let's unpack this, because before we even try to decipher those billions of dollars, we really need to talk about where you actually go to find this unfiltered truth.
Right. The location matters.
Exactly. Because my first instinct, and I think the instinct for most people, is just to type a stock ticker into a financial news aggregator or a search engine and just read whatever summary pops up.
That is definitely the most common approach. But relying on news aggregators for financial data is essentially, it's like eating a meal that has been pre-chewed by someone else.
Oh, wow. That is incredibly gross. But yeah, I mean, you're absolutely right. It is filtered.
Exactly.
You're getting this editorialized version of the numbers, and you're usually getting it with a delay, too.
A delay and a narrative spin. If you want the raw ingredients, you have to go straight to the source. And with Shopify, finding that source is actually a bit of a treasure hunt.
Why is that?
Well, because they use this sort of trifold filing system. They are a dual-listed company, meaning they trade on the NASQ in the U.S. and the Toronto Stock Exchange in Canada under the exact same ticker, SHOP.
Oh, okay. I didn't realize they were on both.
Yeah. Plus, they operate as this digital-by-design workforce, meaning no central physical headquarters. But legally speaking, they are incorporated in Ontario, so their truth is scattered across 3 very distinct databases.
Got it. So I actually tried looking up their earnings on their main investor website, shopify.com investors. But the source material we are looking at for this deep dive strongly suggests that is not the best place to start. Why is that?
Right. Well, the investor relations site is fantastic for getting the company's own framing. That's where you'll find their slick quarterly overview decks.
With all the pretty charts.
Exactly. Beautiful, exclusive charts. It is highly readable. But you have to remember, it's still packaged for consumption. It's marketing material aimed directly at Wall Street.
Makes sense.
So the second place you need to know about is Cedar Plus.
I have never even heard of Cedar Plus. What actually is that?
It's essentially the Canadian government's portal for corporate filings. Because Shopify is legally an Ontario corporation, certain documents just have to live there.
Oh, interesting. Like what?
Well, it's crucial for finding things like their management information circulars, which is basically just the Canadian format for explaining how the company is run and, who gets paid what.
Ah, okay. The governance stuff.
Right. But for the absolute undeniable moment-to-moment source of truth, you need the third part of this system, which is SEC EDGAR.
That's the U.S. government database, right? Where all the massive annual and quarterly reports live.
Yes, exactly. The 10K, which is the massive annual report, and the 10Q, the quarterly version. But there is a really fascinating mechanical detail here about how financial markets actually function.
Ooh, tell me.
If you are tracking this company and you need to know their earnings numbers the exact second they drop to the public, you absolutely do not sit there hitting refresh on Shopify's slick marketing website. You watch the ADGAR database for a specific form called an 8K.
Wait, why the 8K specifically? What's the difference?
The 8K is the legal form a company uses to notify the SEC of any major material event, like releasing their quarterly earnings. When earnings go live, the 8K is filed directly into the government's database at that exact second.
Okay.
The company's own marketing website, on the other hand, might actually lag by a minute or two just because of the publishing delays built into their content management system.
Wow, just because a web page takes a minute to update?
Exactly. And when you are dealing with a company that has tens of billions of dollars in market capitalization, a 2-minute delay isn't just an inconvenience. For an institutional investor running trading algorithms, a 2-minute lag is literally an eternity.
I love that detail because it perfectly separates the presentation from the raw plumbing of the market.
Yeah, it's pure plumbing.
So if we bypass the presentation and look at that actual plumbing, let's talk about what those numbers mean. Looking at their full year 2025 revenue, they pulled in $11.6 billion.
A staggering amount.
Right. And I want to break down the mechanics of that $11.6 billion because it seems to be split into two entirely different business models. First, you have subscription solutions.
Right.
To me, that operates like a massive digital landlord collecting a steady, predictable monthly rent from millions of storefronts. But then you have merchant solutions, which operates completely differently. Merchant solutions feels like setting up highly efficient toll booths on a massive commercial highway.
What's fascinating here is just how completely those toll booths have taken over the highway. If you look back at the early days, almost everyone thought of Shopify purely as software as a service.
Yeah, like you just pay your monthly fee and that's it.
Exactly. You paid a monthly subscription fee to host your website and have a shopping cart. That was the landlord model. But when you dig into the 2025 filings, merchant solutions, so the toll booths, now make up about 75% of their total revenue.
75%.
Yeah. It is the undeniable roaring growth engine of the business. The subscription rent provides a very stable, predictable floor, but the transaction tolls are where the explosive upside actually lives.
And when we talk about those transaction tolls, we're mostly talking about a product called Shopify Payments, correct?
Primarily, yes. Merchant Solutions encompasses a few things, like Shopify Capital for loans or their point-of-sale hardware for physical stores, but payments is the absolute giant in the room. The filings reveal a specific metric you have to watch called payments penetration.
Okay, what's that sitting at?
For 2025, that metric sat at roughly 62%.
Wait, let me make sure I understand the scale of that. In 2025, the total gross merchandise volume, meaning the total dollar amount of every single t-shirt, coffee mug, and piece of software sold across every single Shopify store globally, was $378 billion.
That's right.
Are you saying 62% of that entire $378 billion flowed directly through Shopify's own financial pipes?
That is exactly what it means.
That's wild.
It's a brilliant way to capture value. They aren't just hosting the website anymore. They are acting as the bank teller for the transaction itself. And tracking that penetration rate tells you a whole lot.
Like what?
Well, when Merchant Solutions revenue grows faster than the overall volume of goods sold, it tells you that Shopify's effective take rate is rising. They are squeezing just a little bit more juice out of every single transaction that happens on the internet.
Which clears up a massive misconception I see all the time.
Yeah.
People often assume that Shopify acts like an app store, taking a flat, unavoidable 30% cut of every single sale made on their platform. But looking at the mechanics here, that is totally false.
It is a complete misunderstanding of their model, yeah. Their cut depends entirely on the financial infrastructure the merchant chooses to use.
Right.
If a merchant uses Shopify payments, Shopify acts as the processor and captures that processing fee. But if a merchant decides they want to use a third-party gateway, like maybe a local bank in Europe or an entirely different processor,
Then Shopify gets nothing from the transaction itself.
well, Shopify doesn't get that primary fee. They might charge a much smaller secondary transaction fee depending on what subscription tier the merchant is on, but they aren't blindly taxing the internet. Their revenue is directly, causally tied to how many merchants they can convince to adopt their specific financial tools.
Here's where it gets really interesting. If their revenue is completely dependent on merchants adopting their tools, how can a merchant, or really just a curious observer, use these dense SEC filings to figure out what tools Shopify is going to build next?
That's the million-dollar question.
Right, because the source material explicitly warns us not to listen to the analyst Q&A session on the quarterly earnings calls. It basically says, skip it, it's a waste of time. Why would we ignore the financial experts asking the CEO questions?
Because the Wall Street analysts on those calls aren't trying to figure out what cool new feature is coming to the checkout page. That's not their job. They're trying to build incredibly complex financial models.
Oh, I see.
So they ask highly technical questions about margin basis points, which is just a fancy way of asking about tiny fractions of a percent regarding profitability. Or they ask about currency headwinds, which means asking how the fluctuating value of the euro against the dollar might shrink the reported revenue.
None of which tells me if they're building a new tool I can actually use.
Exactly. None of that helps you, as a merchant, understand if a new artificial intelligence tool is coming to your dashboard. If you want the actual product roadmap, you skip the Q&A entirely and you read the shareholder letter.
So we skip the live audio and go straight to the PDF that gets posted alongside the earnings. But how do you read a corporate letter without just getting completely bogged down in PR jargon?
You have to look for very specific psychological tells, because executives write these letters with an army of lawyers hovering over their shoulders.
Oh, for sure.
Because of SEC regulations, they literally cannot make hard promises without taking on legal liability. So they use a mechanism called a safe harbor statement, and they telegraph their moves using specific verbs.
Like what kind of verbs?
When you see phrases like "we expect to" or "we are heavily investing in," that isn't idle chatter. That is a neon sign pointing directly to what their engineering teams are building for release 2 quarters from now.
Wait, can you give me an example of how that geography data plays into this? Because I noticed they reported international revenue grew 36% in 2025, which is way faster than their overall growth.
That geographic breakdown is another massive signal, yeah. If you see international volume surging like that, you can logically predict the product roadmap.
How so?
It means Shopify is about to pour massive resources into localized checkout experiences, right? Integrating obscure regional payment methods and expanding features like Shopify Markets. They always follow the volume.
That makes total sense. You don't build the tool until the volume demands it.
Exactly. You don't build a complex European tax compliance tool unless you see the European volume spiking in the ADGR filings first.
You are basically reverse engineering the engineering budget based on the revenue geography. I love that. And speaking of telegraphing the future, there is a fantastic quote in the source material from Shopify's president, Harley Finkelstein, from their Q4 2025 release.
Oh, yeah. The builder quote.
Yeah, he wrote, 2026 will be the year of the builders, and we'll be powering them from first sale to full scale. And honestly, when I read that, it just sounds like a nice motivational poster.
It does sound like a poster. But in the context of a shareholder letter, it was an explicit, highly actionable signal. By emphasizing builders and full scale, he was directly forecasting the rollout of massive structural tools.
Like what?
Well, within months, we saw the launch of Sidekick, their AI commerce assistant, and the Universal Commerce Protocol. He was telling anyone paying attention exactly where the R&D money was going.
And we should definitely talk about that R&D money because it is staggering. I mean, if they are generating $2 billion in free cash flow for 2025, who actually decides how that massive pile of money gets spent?
That is where things get a bit controversial.
Right, because when you have $2 billion just sitting there in pure cash flow, corporate governance becomes incredibly important. And looking at the corporate structure in their proxy statements, which I think is called the DEF 14A, it doesn't look like a standard shareholder democracy at all.
No, it is absolutely not a standard democracy. The DEF 14A is the document filed on EDGR that outlines who sits on the board, how much the executives get paid, and most importantly, how voting power is distributed. And Shopify utilizes a dual-class share structure.
I have to push back on this, or at least, play devil's advocate here.
Go for it.
Because the filings show that the public trades Class A shares, which get 1 vote per share. But the founder, Toby Licky, holds a special class of shares that gives him exponentially more voting power per share. Doesn't that effectively make this publicly traded company a dictatorship? I mean, if I buy stock, I essentially have zero leverage over how the company's run.
If we connect this to the bigger picture, it is a deliberate, highly calculated trade-off. It is actually incredibly common in the tech sector. You see it with Alphabet, Meta, and massive Canadian holding companies like Constellation Software.
So it's not just them.
Not at all. Yes, it concentrates total voting control with the founder, even if they don't own the majority of the actual economic value. But the public markets tolerate this, and sometimes they even prefer it for growth companies because of one specific word: insulation.
Insulation from what, exactly? Wall Street.
Exactly that. It completely insulates Shopify from short-term activist pressure. Think about a normal company. If you have a bad quarter, a massive hedge fund could swoop in, buy up a chunk of stock, and use their voting power to force the CEO to slash the R&D budget just to juice the profit margins for a quick payout.
Oh, yeah, that happens all the time.
Right. But with a dual-class structure, Toby Litkey can simply say no. It allows leadership to make agonizingly difficult long-term pivots that might look terrible on a balance sheet for a year or two, but are structurally necessary for the company to survive the next decade.
Which perfectly explains some of their seemingly erratic capital allocation moves. Like, the fact that they have never paid a dividend. If you own the stock, they're never sending you a quarterly check. All that cash goes right back into the machine.
Always reinvesting.
Right. But then, in February 2026, they authorized a massive $2 billion share repurchase program. If they're aggressively growing and have zero debt, why spend $2 billion buying back your own stock?
To understand that buyback, you have to look at another piece of financial jargon in the filings, which is stock-based compensation. Shopify, like most tech giants, pays a huge portion of its engineers and executives in stock rather than cash. It runs roughly 10 to 12% of their total revenue annually.
Wait, let me stop you there and just define stock-based compensation for a second, just so we are totally clear on this.
Sure.
When a company pays its employees in stock instead of cash, they are essentially printing brand new shares out of thin air. And when you print new shares, you are diluting the pool. You are making the pie bigger, which means the slice of the pie that I own as a public investor gets slightly smaller and less valuable.
That is the perfect analogy. So that $2 billion buyback isn't necessarily a massive signal that they think their stock is drastically undervalued. It is primarily a maintenance mechanism.
Oh, I see.
They are going out into the open market and buying up $2 billion worth of stock to destroy it, shrinking the pie back down to offset all those new slices they printed to pay their engineers.
That makes so much sense. It's treading water, basically.
Exactly.
But the most dramatic example of this founder-led insulation has to be their M&A strategy, their mergers and acquisitions, specifically around their logistics disaster.
Oh, that was huge.
Right. In 2022, they acquired a company called Deliver. The narrative was that Shopify was going to build out physical, owned fulfillment infrastructure, like massive warehouses, to compete directly with Amazon's physical delivery network.
The Amazon of the North, right?
Yeah. And then, literally a year later, in 2023, they divested Shopify Logistics entirely. They sold it off to Flexport, completely reversed course, and went straight back to pure software.
It was one of the most violent strategic reversals in modern tech history, and it highlights exactly why the dual-class share structure exists.
Because no normal board would let that happen so fast.
It's highly unlikely a traditional, non-founder-controlled board of directors would have moved with that kind of velocity. Reversing a major acquisition after just 12 months comes with a massive reputational hit, and usually a brutal, short-term financial write-down.
Right. People lose their jobs over that.
A typical corporate committee would have spent 3 years commissioning consultant reports to slowly wind it down, just to save face. But because the founder had total control, they could look at the data, admit they made a massive mistake, realize physical logistics was ruining their margins, and amputate the division immediately.
Wow. So what does this all mean? When we strip away the billions in revenue, the massive free cash flow, and these brutal pivots, what is actually threatening this machine? Because every single 10K legally requires a section called risk factors, where the company has to confess everything that could basically destroy them.
The risk factor section is arguably the most illuminating part of the entire ADGR filing because it legally strips away all the marketing spin, and Shopify themselves lists several existential vulnerabilities.
What's the biggest one?
First is their immense dependence on third parties. We talked earlier about how Shopify Payments is the roaring engine of their revenue, right?
Yeah, the toll booths.
Well, Shopify doesn't actually process those payments entirely on its own. They are heavily dependent on a very small number of back-end acquiring partners, primarily Stripe.
Wait, so if Stripe suddenly has a massive software failure, or if Stripe decides to drastically alter its pricing model, that flows instantly and directly into Shopify's top-line revenue.
Precisely. They don't control the very bottom layer of their own most profitable pipe. They also cite intense take rate pressure in that section. The margins on processing credit cards are incredibly thin.
Let me try to visualize that. Think of Visa and MasterCard as the highway patrol on that commercial highway we talked about earlier.
I like that.
If Visa and MasterCard decide to raise the tolls they charge Shopify, Shopify's profit margins get squeezed instantly, unless they pass those fees onto the merchant. And passing it on might drive the merchant away entirely.
That is exactly the dynamic. Add to that their macroeconomic exposure. Since their toll booth revenue is completely tied to the volume of goods sold, if consumer spending drops during a global recession, Shopify feels the pain the absolute second the consumer stops buying.
Because they're taking a cut of every sale.
Right, and remember that foreign exchange exposure we discussed, because they report their massive earnings in US dollars, but a huge chunk of that $378 billion is happening internationally, in euros, yen, or pounds.
Oh, right.
So if currency values swing the wrong way, their reported revenue takes a massive hit on paper, even if the underlying business didn't change at all.
And they also highlight the competitive threat, right? But not just from traditional competitors like Adobe or Amazon. They specifically mention the threat from social commerce surfaces like TikTok Shop or Instagram. If the entire transaction happens inside a social media app, Shopify's role as the beautiful storefront gets completely bypassed.
Exactly. The transaction basically becomes invisible to them.
Okay, we have covered a staggering amount of ground today. If you were reading along with us on this deep dive, you now know how to bypass the delayed pre-chewed noise of aggregators by going straight to SEC EDGR for the raw 8K drops.
Yep.
We broke down the tension between the steady rent of subscription solutions and the explosive highway toll growth of merchant solutions. We figured out why you should totally ignore Wall Street analysts asking about margin basis points and instead look at the psychology of the shareholder letter to predict the product roadmap.
That's the real cheat code.
And we explored how a heavily insulated founder-control board can make brutal, necessary pivots, like abandoning physical logistics practically overnight.
But there is one final piece from that risk factors section in the 2026 10K that we didn't fully unpack yet, and it is arguably the most profound. Deep in the filing, Shopify explicitly names a fascinating threat, which is AI disruption to discovery. They are warning investors about the rise of agentic commerce.
Agentic commerce. What exactly does that mean for the average person listening?
It describes a rapidly approaching future where AI assistants, digital agents, basically do the shopping for you. Imagine you just tell your AI, hey, find me the best pair of trail running shoes under $100.
Okay.
The AI goes out, scans the entire internet, verifies the materials, finds the best price, and just buys it. So the question I want to leave you with is this. If agentic commerce becomes the absolute norm, if we reach a point where bots are primarily buying from other bots, what happens to the very concept of a digital storefront?
Oh, wow.
Does the highly customized, psychologically optimized, beautiful Shopify website, the very thing this company is famous for enabling, become completely obsolete? I mean, if a machine is making the purchase, it doesn't care about your clever font choice, your lifestyle photography, or your brand's emotional storytelling. It just reads raw data. How does a $100 billion empire built on visual storefronts survive when the primary buyer no longer has eyes?
That is a staggering, slightly terrifying thought to mull over. It really flips the whole model upside down. Well, if you want to keep digging into this machinery on your own, take the advice from our source material. Go start a $1 a month trial on Shopify. Don't build a business, just explore the admin backend. Look at how the payments are structured. Look at the geographical tax settings. See the raw plumbing for yourself. That wraps up our deep dive for today. Keep questioning the numbers, and we will catch you next time.